In its first quarter policy review for 2013, the RBI today offered a mixed bag. The good news is that consumers will not have to pay more on loans for cars or homes anytime soon, since key interest rates have been left unchanged. The bad news, though, is that the government is now acknowledging that inflationary pressures will continue to pose a serious threat to the economy.
He had a near impossible task ahead of him, but RBI Governor D. Subbarao attempted a fine balancing act in his last policy statement, keeping key interest rates unchanged, which translates to no increase in EMIs on car, home or personal loans.
We've decided to keep the policy repo rate under the Liquidity Adjustment Facility, LAF, as also the cash reserve ratio CRR unchanged. Accordingly, the repo rate stays at 7.25%, the reverse repo at 6.25%, and the CRR at 4% of the net demand and time liabilities NDTL of scheduled banks.
For the RBI, the priority clearly has shifted from reviving an economy growing at its lowest pace in a decade to nursing a battered currency that has recently plunged to record lows, and all its efforts to tighten money market liquidity and push up short-term interest rates in a bid to bolster the rupee has only taken a toll on India's growth forecast.
India is currently caught in a classic impossible trinity trilemma. We're having to forfeit some monetary policy discretion to address external sector concerns. The growth projection for the current year is revised downwards from 5.7% to 5.5%.
Though the RBI pledged to keep inflation at a check and promised to roll back its recent tough measures once the global market stabilizes, not everyone is convinced by their optimism.
नहीं बल्कि सारा अंतर्राष्ट्रीय जगत इस बात से परिचित है भारत की अर्थव्यवस्था इस समय लड़खड़ा रही है.
With political pressures adding to its woes as it struggles to fight against a tough global economy, the UPA is clearly walking a tightrope and every move is being watched. Bureau Report, Times Now.